Each year, Microsoft Research hosts hundreds of influential speakers from around the world, including leading scientists, renowned experts in technology, book authors, and leading academics, and makes videos of these lectures freely available.
So, we are very happy to have Ben Handel here from Northwestern. Are you from Kellogg or from the Econ Department?
From the Econ Department.
From the Econ Department, okay. And he will be talking about adverse selection and switching costs in health insurance markets when nudging hurts. Do you hear that?
Yeah.
Okay.
Yeah, that's great. Thank you for coming. So this paper studies the two potential problems of switching costs and adverse selection in the context of health insurance markets. So switching costs can arise from a variety of sources and lead to inefficient persistence in health plan choice over time. Adverse selection has been a big concern in health insurance markets and arises when in this setting and in many settings because firm costs depend on who's buying the product in this setting. And in health insurance, firms can't perfectly price discriminate between different consumers. So, for example, across a spectrum of health insurance markets, so either employer-provided insurance.
Let me slow you down a little. Not everybody here is
Sure.
an economist, so they might not know what adverse selection, what the technical term means.
Mm-hmm, sure. So in this setting, as I mentioned, adverse selection occurs because firm costs in insurance depend on who buys the product. So if you have a population, if you're an insurer and you enroll a population of consumers who are very high health risk, then your costs are going to be higher because you're going to be paying out more claims for these consumers.
What does adverse selection mean?
I'm getting to that. Yeah. No, sorry.
But only sick people.
Yeah. So then what happens? So then what happens is that when only sick people buy kind of the most comprehensive insurance, then the cost of that insurance goes up for everybody, and so the price of that goes up for everybody because you can't price discriminate in this market. So then what happens is that, say you're a healthy person, but you would like to have more insurance because you're very risk averse. Adverse selection is kind of, the result of adverse selection is that you can't buy comprehensive insurance in this market because sick people are basically driving up the price. So basically it's a market failure issue where comprehensive insurance becomes unavailable to you because of this kind of link, because of this sorting link. So as I was saying, in most healthcare settings, price discrimination is illegal or not allowed. So the kind of phenomena I just described is very kind of likely to be present. And in addition, switching costs are likely to be a significant issue in health insurance because health insurance is in some sense, a very difficult product for consumers to choose between because there's many different financial dimensions and kind of when you're choosing a health insurance plan, as well as many kind of complications in terms of the medical providers you're enlisting, etc. So in the paper, I ask three primary questions. The first question is, are switching costs large? So is there significant persistence in choice from a variety of sources, which I'll describe in a second? And if they're large, do they have a significant impact on health plan allocation? My second question studies the link between switching costs and adverse selection. So when switching costs are present, consumers make worse decisions over time because they don't kind of optimally switch across plans over time because there's this choice friction. That's going to have an impact on adverse selection in this setting because adverse selection obviously depends exactly on the pattern by which consumers are choosing health plans. So,
might it also simply be that once you get sick, since switching costs are high, you tend to stay in?
Absolutely. Absolutely. That's exactly kind of the phenomenon I'm thinking about. So these kind of issues have been studied a little bit theoretically, but not at all empirically. So, and kind of a point I want to bring up here is that this analysis, so more broadly, switching costs is kind of a choice inadequacy issue or a choice friction issue adverse selection is kind of a market failure issue studied traditionally in industrial organization. And this is kind of one of the first empirical papers that's studying the link between kind of two of those type of phenomena in one paper. So finally, what I'm going to do is I'm going to kind of estimate an econometric model that's going to kind of quantify these forces. And then I'm going to study the welfare impact in a counterfactual setting. So I'm going to use my estimates to simulate a market where I have policies at my disposal that reduce switching costs. So policies that improve the information consumers have or reduce the potential inertia costs consumers have. And what I'm going to find there is that actually improving consumers' choices by improving their information can actually have a negative welfare effect because of...
Is that sort of a simulation result or a result with actual people?
So I'm going to estimate an econometric model that's based on kind of actual people, actual data, and then I simulate, based on those estimates, I simulate a counterfactual setting. So what I mean by that, so let me be clear. So what I mean by that, so econometrically, I'm going to explicitly estimate a choice model. So I'm going to explicitly estimate kind of theoretical parameters for an expected utility function for consumers. Then what I'm going to do is so within that function, I'm going to estimate switching costs. And then in the simulation, I'm going to reduce the level of switching costs from the estimated amount, and then assume that kind of consumers are re-optimizing based on that simulation. So before I go further, I'd kind of like to discuss exactly what I mean by switching costs, because this is kind of a pretty broad term that I'm kind of grouping a lot of different potential things into. So there's a couple different sources that could contribute to switching costs in my setting. So one potential source is what I'm going to call transaction costs, which is kind of an explicit source of switching costs. So one example of transaction cost is the time and hassle costs of actually going to kind of fill out paperwork and change your health plan. Another potential source is the time and hassle cost of researching alternative health plan options, which can be quite a significant cost since it's a complicated product to analyze choice between. In addition to kind of that more explicit cost, another potential source of switching costs in my setting is what I'm going to call status quo bias or inertia. And that is kind of a more behavioral phenomena that basically leads to persistence in plan choice kind of on top of this kind of explicit transaction cost. So that could kind of arise both for potentially psychological reasons or for kind of for reasons of kind of higher order expectations, which I'll talk about soon. So
You didn't mention is that if I stay in some health insurance, I develop asthma and I go to a new one, they might say I don't cover your asthma, or I sort of will put an additional part of it you have to pay yourself, so there may be actual costs that develop over time.
So the pre-existing conditions problem is a major problem, obviously, in kind of insurance discussions currently. Now in this setting, it's not going to be an issue because I'm going to study data for all employees at a large firm. And so once you're enrolled in the firm, there's no pre-existing conditions restriction when you switch across different health plans.
What units are you measuring the switching costs in dollars?
So dollar units.
How are you converting these things into dollars?
Sorry?
How are you converting these things that are on the slide into dollars?
Sure.
It seems hard.
So I mean, the transaction costs type argument, that's easy to see. I mean, in some sense. I mean, that's...
They actually charge you money for switching.
No. Sorry. So...
You measure the number of hours they spend researching and you convert that into dollars at some rate.
No, absolutely not. So what I'm going to do is, basically what happens is I'm going to observe kind of in the data, I'm going to observe people making choices in period without switching costs, and I'll kind of describe exactly how in a second. And I'm going to observe consumers making choices in periods with switching costs. And so then, based on the model that I study, which tells me how much consumers should value health plans in the absence of switching costs, I'm able to kind of use the identification in these data across these different states to tell me what the value of switching costs is based on the way I've set up the model. So it's contingent on the model. Mm-hmm.
And that lets you separate between these three categories?
No. So,
You lump them together.
so these are all lumped together in my setting.
What about the following though? Like, I mean, let's say I buy a car, okay,
Mhm.
and I'm hesitating. Is it really worth it? Is it worth it? I buy it. I'm happy. The next morning, I'm feeling in a bad mood. And I feel like, it's not really worth it. I can go off and sell it immediately. I mean, there's some value in just like sticking to what you do, because if isn't there some sort of general value in that, like switching back and forth between things, because otherwise you'll constantly be. Which category did that fall into?
So I think.
Lanes on a highway.
Yeah,
Kind
exactly.
of. Okay.
Right. So I think I actually get what you're saying. So what you're trying to say is almost just from kind of like an ex ante perspective. If you're going to make a specific choice, maybe you want to kind of commit to making that choice.
Yeah, it's irrational to go with you. It's actually rational sometimes to stick a little bit with what you go. Otherwise, you'll constantly be getting married and divorced and married.
His wife is sitting next to him.
Not me and Greg. other people.
So
You should see what remarks he makes when you're not in the room.
So I think that kind of issue could actually fall into kind of a couple of these categories, in the sense that you could kind of view the ability to commit as kind of as imposing some cost kind of on you from kind of a static allocation perspective. So I also wanted to point out that one of the sources of switching costs that I'm not measuring are switching that occurs when, to switch health plans, you also have to switch who your doctors are. So you have to switch who your medical providers are, which is a real problem in health insurance. Now, the reason I'm not studying this is because in the setting I observe, I'm going to observe consumers making choices between multiple health plans that have the exact same medical network of providers and cover the exact same medical services. So the difference between these plans is going to be based on financial dimensions only, so cost-sharing dimensions. So because of that, the kind of switching costs that I estimate in the model are essentially going to be kind of you could think of it as a lower bound for what switching costs would be in a more general environment where you also have to switch across providers. So I'm going to describe the data kind of briefly and then get into it in a little more detail in a minute. So to study these two problems, I study a proprietary panel data set that has 5 years of health insurance choices and 5 years of very detailed medical utilization information for all the employees at a large firm. So the data set is kind of unique for two reasons. One reason is in the literature, most studies don't have access to this kind of detailed medical information. A second reason is that in the middle of this 5-year period, the firm that I study almost completely changed the entire menu of 5 health plans that they offer to their employees. And in the process of doing so, they forced employees out of their previous plan that they were enrolled in and required them to enroll in a new plan from this new menu of plans without a default option. So there was no default option in that period. So the way I think about this is I think about it as in this period of the menu change, consumers kind of had to make an active plan choice from this new menu of plans. Then I observed the same consumers over time making decisions in situations where they do have a default option, but prices and the market environment have changed quite a bit, such that if there were no switching costs, so if it were a frictionless market, you would expect consumers to be making different choices. So, and what I'm going to do is, in addition to showing these phenomena and kind of preliminary results that are kind of based just on the data alone, once I do that, I'm going to study an econometric choice model, kind of like I was just describing, where I'm going to model the decisions that consumers make under uncertainty. So I'm going to model their risk preference parameters. And in that model, I'm going to jointly quantify in the decision-making process what their switching costs are, so this kind of persistence element, what their health risk is ex ante. So I'm going to use past health data to kind of try to mimic the information set of people at the time of plan choice. And then, as I said, I'm going to also kind of incorporate that with an estimate of what consumer risk preferences are, which I'm able to estimate by kind of revealed preference choices in the data. So the main results are, first, I show quite significant evidence of large switching costs, which lead to poor choices as the market environment changes over time, then you could pretty much replace the word counterfactual with simulation here, if that kind of makes more sense.
Because there is also an empirical economics sort of counterfactual where you do experiments on actual people, and that it would also counterfactual.
Yeah, sure. So in my partial equilibrium, so what I do is once I estimate this econometric model and I recover kind of all these choice parameters for consumers, so in essence modeling how they're making decisions, I investigate what I call a partial equilibrium environment, where I investigate what happens if I have policies that reduce switching costs, so improve consumer information, but in that counterfactual, I hold insurance prices fixed as I observe in the data. So I assume that consumers are making better choices, but insurers aren't re-optimizing in the market. So in that case, the policy to reduce switching costs can only improve consumer welfare, because you're kind of improving their decision making, holding everything else constant. And in that setting, I show that eliminating switching costs improves consumer welfare by 10%. And I'll kind of discuss exactly what that metric means soon. Then I go beyond that and I say, okay, now let's think about what happens in what I call a full equilibrium setting, where insurers adjust prices in response to updated consumer choices from this reduction in switching costs. There what I find is that the same policy that eliminates switching costs still improves consumer choices, conditional on what the prices are, as you'd expect, but now also significantly exacerbates this adverse selection problem, leading to a 6% decrease in consumer welfare. So kind of intuitively what happens there is that because consumers are in some sense more rational and kind of sorting more on the margin as their switching costs are lower, the price of more comprehensive insurance, so the most comprehensive plans, ends up increasing quite substantially relative to the case with switching costs. And the market share of that plan goes down quite substantially, because that plan now becomes essentially unavailable to a large part of the population. So previous work, I think that this study kind of contributes.
Let me ask you a question. If I look at this and step back a little bit, I would say, so does your model take into account that people may change actions and go to the doctor or not go to the doctor depending on the insurance options they have or not?
Mm-hmm. So,
because otherwise I would just argue, look, the medical costs are fixed and you change policies, but in the end, the sort of the total utility of everyone, unless you sort of waste money, should just stay constant.
Well, so what I'm doing is I actually use this kind of menu change to observe consumers in certain plans before this menu change and certain plans after, and how they're consuming medical care before and after when the incentives in plans are different. And so there's two possible effects there. One possible effect is you could be choosing a less comprehensive plan after this menu change because you have kind of certain private information that I don't observe about medical expenditures. Another reason could be the reason you gave, that if you're in a plan that has higher copays and higher deductibles, you're going to go to the doctor less. So I do some data analysis looking at kind of the behavior before and after, and I show that the effect on overall expenditures of these two effects is quite minimal. And in fact, that shouldn't be so surprising, because I think at least kind of intuitively, like 80 to 90% of most medical claims are what I would classify as inelective medical claims in terms of dollars, total dollars. So for example, if you have a heart attack, it's not going to, the amount of money you spend won't be kind of higher or lower kind of in any of these plans.
But you're not looking at the secondary effects, that if you don't get the relatively inexpensive elective procedures, then it could have an impact on your overall health, which would have
Right.
a big impact on the claims you make down the road.
Right. So that could. I agree with that. But I mean, in this case, consumers are going to be making choices for a 1-year time
Right.
horizon.
This is a
Yeah.
short term, because there are these long-term effects. Right?
Exactly. So before I kind of move to the model, I'm going to show a couple preliminary results and provide some intuition for the phenomenon I'm talking about. So this chart shows two of the health insurance plans that I observed in the data. On the x-axis, and this chart is for the year I'm calling T0, which is the year of this menu change that I described. So on the x-axis are total medical expenditures, which are the amount of medical expenditures paid combined by the insurer and the employee. On the y-axis are total employee expenses. So that's how much you spend out of pocket kind of as a function of these total medical claims. And so what you can see here is that the y-intercept is the yearly premium you pay for out-of-pocket for each of these plans. The next portion of this line is your deductible, which should be a one-to-one mapping between employee expenses and total expenses. The next portion of the line is a coinsurance rate, which is a flat percentage you pay on total incremental medical expenditures over that range. And finally, after some point, you reach what's called an out-of-pocket maximum, where for any incremental medical expenses, you don't pay anymore. So this chart compares two plans, and what you can see is that sick people should choose more insurance, where by more insurance I mean the blue plan, because you have lower deductible and lower coinsurance in that plan. And healthier people should choose the orange plan, because as your total expenditures get lower, you want to choose the plan with higher deductible and higher coinsurance. So this is kind of, there's nothing surprising here. So then this is what happens in the next year. Yep.
Sick people weren't too sick. If you're really sick, you should choose the red one.
Sorry? No.
Because you're, sorry.
You're being murdered.
Okay.
Yeah.
If you're really sick, like you think
Yeah.
you should pay more.
So this is what happens in the next year. So this is year T1. So the only difference between this graph and the graph I just showed you is that the y-intercept shifted. So premiums changed quite significantly over these 2 years as a result of kind of this adverse selection effect I'm talking about. So people sorted based on health risk into these two plans in year T0, and then these premiums changed quite significantly, because premiums here are basically reflecting average cost plus some subsidization by the firm. So what you can see here is that in this year T1, kind of a year after, so 2 years after the menu change, for people in this demographic group, you should choose the orange plan, which is the less comprehensive plan, for any level of medical expenditures you have. So I phrase it as the orange plan dominates the blue plan in essence. So no matter how sick you are, you should always choose the less comprehensive plan. And in fact, if you enroll in the orange plan here, you're going to be saving at least $1,000 relative to the other plan. So yeah, this is real. Yeah.
This is like after the fact, right? I mean, it's not that if somebody...
It's due to adverse selection.
No, but it's
And
not that
adjustment
when
of
somebody, when they
premiums.
present these two plans to you, I mean, this is an average, right? So there may
No, this isn't an average.
Policy.
No.
It's just, this is clearly determined for the policy.
This is
right?
the policy. It's like the math.
So every point,
Deductible.
every point on one of these lines is like a state. And so this is kind of the x-axis is kind of like all the possible states that could occur when you kind of enroll in one of these insurance
plans.
plans.
$4,500 a year. It's like determined uniquely how much.
Exactly.
And there's
Exactly.
So the yellow, the orange one is the low deductible, the blue one is the high deductible.
No, the reverse.
How come that if you spend zero, also up to you?
So there's premiums. So the y-intercept is the premium.
So this information is all
You have to pay something for the plan.
Oh, I
So the
see.
information is
Before
all
you
available
ever use it.
in the sense that the documents would tell you basically what the slopes of all these things are and where
Yeah.
the changes in slope are, but they didn't draw this picture, I'm assuming.
Absolutely. So all this information was available in an open enrollment booklet that kind of employees at the firm got in November.
It's completely incomprehensible.
But it's hard to understand. Absolutely. It's very hard
I've seen
to...
quite a few of those booklets, and
Yeah.
none of them are comprehensible at all.
So for example, in year T1, so in this year, relative to the previous year, there was like a line on kind of like page 7 of the booklet saying premiums changed. And that was it. So that's kind of, that would give you kind of some idea of the level of
I still don't
information.
understand it. Up to the deductible, my cost should be just the premium plus the actual cost. So which means
That's
that
percentage of
Oh, you're saying the slope should be 50, should be...
It should be the same on both. It should be
So the slope should actually be the same
Right.
on both plans here, but it's like just a skewed thing. So it actually is.
It is.
Yeah, it actually is the same. Yeah, yeah.
So did the company realize that you were offering one plan that was totally dominated by another?
So no, so they did not. They did not realize that. So
Did they change this once you pointed it out?
so surprisingly
Were
not.
they doing self-insurance or not?
So they're self-insured. Surprisingly, they did not. Surprisingly, they did not change this. And
Nor did they tell their employees.
Nor so when I brought this up, they were actually quite defensive about it because they thought I was going to go tell the employees and get them in trouble. So what surprised me was that then for the next year, which I also have data on in here, they still didn't change these prices. So these prices are the same pretty much in year T2. And that was surprising to me because to me that kind of showed me that, you know, in some sense they didn't understand what I told them.
No, wait. Isn't it in their interest to actually, once they see this curve, to tell all their employees to go to the blue curve? Because then the firm
It depends if they care about their employee
The
welfare or
firm pays
not.
less,
Where does
the
the money
employees
go?
pay more.
So the way plans are kind of ultimately priced at the firm is according to an average cost rule. So what that implies is that it's essentially a zero profit condition. So it implies that kind of no matter where employees are, kind of it's going to be zero profit from the firm perspective.
So how could that be given these curves?
The adverse selection, all the sick people went into the top plan.
So
And so they're trying not to lose too much money on the top plan, so they just raised everything.
well, so here's what happens. So there's two distinct components here. So one component is the pricing. One component is the contract characteristic. So everything kind of to the right. Those two things are kind of decided separately. So the firm, for example, is not analyzing this chart. They're not analyzing these two things together. So premiums, so the y-intercept is being analyzed based on just a simple kind of average cost rule, saying what was the average cost of employees in this plan in the last year. Then these contract characteristics, the deductible and coinsurance, were determined the year before and kind of not reanalyzed. So that's kind of why this happens.
It's not actually zero sum because like they're using numbers from last year. If the numbers from last year appeared again, maybe it was
Right.
zero sum, but it's not actually. So they may actually make much more money from the blue people this year.
Well, it's kind of a long run zero sum argument. Yeah. And they're certainly not thinking about it in that way. I know that for sure.
Wait a minute.
In fact, you're saying they're not thinking very much at all, but.
Yeah, exactly.
I'm still confused in the same way that I think Christian is. The guys that are on the blue curve are paying more.
Yeah.
Therefore, and the total costs of the whole thing are fixed based on the amount of medical care. They get.
Yes, but
Therefore, the firm must be paying less for the
That-
guys that
so-
are on the blue plan.
So that's not true. So the reason why is that the people in the blue plan are sicker people. So what's happening is that people are paying more for the blue plan, kind of upfront, the premium they're paying more, but they're also the sickest people in the population. So if those people switch to the orange plan, then that plan is going to become more expensive and kind of these lines.
Something more about the cost sharing.
Mhm.
That was confusing people, so that
Yes.
he's thinking that the only thing the firm cares about is the premium.
No, I'm just looking at the total expenditure. And how it's divided up.
Of the firm and the.
Total expenditure on medical care minus the amount the employees pay is the amount the firm pays.
So think about it from this
The employees
perspective.
pay more on the blue plan, therefore the firm is paying less.
No.
Actually, he's right, because if I choose a lot of points at 30,000, okay, then for each of them the firm has to pay 30,000 minus 7, 23,000.
Exactly. So
Okay. And whereas if there's a lot of people at 3,000, no matter on which one you are, you pay much less for those.
right. So another way to think about this chart is that, so this is a chart for kind of any one employee. But if you then kind of take one employee at kind of a fixed level of expenditure, so say 30,000, the firm is ultimately, going to pay the same amount for this employee, whether they're in the orange plan or the blue plan, because what's going to happen is that employee's expenditures are going to contribute an expectation to the average cost for each plan, and the firm is going to pay the residual kind of amount of that as the difference between the out-of-pocket expenditures in these two plans.
So it's like next year it'll be different.
Yeah, exactly. Next year.
So that's the thing that isn't captured by this curve.
Even this
Right, and
year,
that's what Adam was
Yes,
saying.
no, absolutely.
Here are some
I agree with that.
across years.
I agree with that. Absolutely.
But you also probably, what is the average cost for the firm? The average cost per employee for the firm must stay constant.
Exactly.
100%.
Exactly.
So the average cost per employee in the red plan must obviously, well, that's not, yes, it must, in the orange plan must be lower than in the blue plan.
Yes, the average cost to the firm is lower, but that's why the
No, may not.
No.
No, because the distribution curve is different. The other ones are peaked on the right. So the average, do you know what the average cost per employee is in the two plans? Because I think if we put these numbers down, we would lose our contribution.
yeah, it's pretty. So the average cost per employee is actually quite. It's actually quite similar to what you see here, and the reason why. Oh wait. So this isn't true. So here's the reason why it's not true. The employee premium here is determined based on the average cost rule for determining total premiums, but then also based on the way the employer is subsidizing the employees. So this number here, the y-intercept for the orange plan, equals average cost from employees in the previous year minus a subsidy that the firm is giving to the employee. So this price here doesn't actually represent the average cost. It represents some portion of the average cost, kind of incorporating this subsidy.
But do they give the same subsidy to the people who choose the blue plan or the orange plan?
Yes.
Same average subsidy?
Yes. The same exact subsidy.
Same exact subsidy? Oh, yes, of course. The
So,
subsidy's the same,
yeah,
right.
yeah. So I'm going to move forward, but I'd be happy to talk about this more later. So in the data specifically, I observe, in addition to health choices, I observe things like flexible spending account choices and contributions, health savings account choices and contributions, and dental and vision plan choices. So I observe a lot of choices that people are making. On a demographic level, in addition to kind of more standard demographics, I observe things like what division within the firm you work in, whether you have an advanced degree, which is often linked to the division, whether or not you work in a group within the firm that's a quantitative group, which is something that kind of I sat down with someone at the firm and kind of identified myself. On the medical side, what I mean by detailed medical data is I observe every claim for every individual and covered dependent who's enrolled in a PPO option. And I'm going to kind of get into what the options are in the next slide. Now, what a claim means is a diagnostic code, which is one of 25,000 different medical diagnoses that you could have every time you go to the doctor. A procedure code, which is what procedure was performed, who the provider was, and what their specialty is. And then on the financial side, I observe basically the entire breakdown of payments for a given claim. So pretty much what the insurer would observe. So I observe how much the insurer paid, what was paid for deductible, co-insurance, co-payment, as well as what the date of the claim was. So this is a very rich set of medical information. So I'm going to describe the kind of forced re-enrollment, which we talked about earlier. So year T0 is the year that the firm changes plans. Before year T0, the firm offered 4 HMO options, which are kind of less flexible options in terms of which providers you can go to, and 1 PPO option.
So the sicker people would tend to go to the PPO.
Generally that's true, though the plans are thought to be also, those types of plans can be horizontally differentiated based on kind of what your tastes are for kind of, it depends in some sense.
Okay.
So in general, I would say that's true though.
Really, I would just have thought the opposite.
No, you want more choice if you're sick, because you want to pick your specialist if you're sick.
Yeah, that's the general
kind of
trend.
like the rule of thumb.
Yeah, that's the common wisdom. I agree.
Common.
Yeah, I agree. Yeah. So after the menu change, the firm retains 2 of the previous HMO options, so 2 of the previous options are the same, and offers 3 entirely new PPO options. So that's the sense in which kind of after the menu change, 60% of the plans offered are entirely new to people at the firm. So, as I mentioned before, I kind of conceptualize people as making an active choice in year T0 because they're choosing from this menu of plans which is predominantly new. They were forced out of their old plans, and there's no default option, so they have to kind of make a selection.
Try to evaluate the possibility that people that were already enrolled in one of the incumbent HMO plans just stuck with it.
Absolutely. So
that distort things to some extent.
So absolutely, I agree that does. And so actually, in the choice model that I study choice only among the PPO options. And what I show in the data is that there's very little switching between the nest of PPO options and the nest of HMO options. So in that sense, I feel there's probably a low selection bias in terms of just restricting the analysis to people who are in the PPO options. And that's convenient for multiple reasons. That's convenient because I don't have to kind of analyze these incumbent plans, which presents an issue, and I observe the detailed medical data I just described just for the people in the PPO options, which I'm going to use. And just to point this out again, because this is important, these three plans are only differentiated, the three PPO plans are only differentiated by financial characteristics, so no difference in doctors or medical providers. So this chart describes kind of some of the characteristics of these plans. I'm going to go through this quickly, but feel free to ask questions. So I index the plans by what their deductible is. So what that implies is that a lower number on the index implies that the plan is a more comprehensive plan. The individual level deductible over this range of plans varies from $250 to $1,200 in a year. The numbers below are the family numbers, which are larger. The coinsurance rate changes from 10% to 20% across these three plans. So that should be considered like the marginal price of care post-deductible, and that doubles over the range of these three plans. In addition,
That's something which seems strange. If I pay a higher deductible, I would say that given that I pay a higher deductible, then I should get higher coverage rate when I'm insured.
how do you mean?
Well, I would say, look, if you're willing to take a high deductible, I then offer you more full coverage once you have the higher.
It's the premium.
No. The co-insurance means if I'm sick, I have to pay 10% myself, right?
After the deductible, after you pay the deductible.
Yes.
Right. Right.
The entire rate.
So
No, but it's 20% there, so you have a higher deductible.
Christian, the game is to try to make the premium lower as you move to the
yeah, so what happens is that you're paying more in the plans on the right on two dimensions.
Right.
You're paying more on the deductible, and then after that you're also paying more.
Right.
So in a sense, it's kind of like sorting between people who want less coverage overall and more coverage overall, because both things point in the same direction.
So one would expect that the premium for the leftmost, the rightmost is the least.
Exactly. And so finally, these plans have an out-of-pocket maximum, which is linked to what your income tier is within the firm. So what that implies is that the firm has 5 income tiers. These income tiers are $40,000 increments from $0 to $160,000, and then one tier for everybody above $160,000. So I already kind of showed some evidence of the large price changes, so this kind of explores that in a little more detail. So this looks at the price changes from year T0 to year T1. So plans are priced based on the income tier as well, and that's because people are given subsidies by the firm, which depends on what their income tier is. So the yellow bars here are prices in T0. The blue prices are in T1. What you can see is that if you focus on the left on PPO 250 and income tier 5, you can see that for that group of people, the actual amount they pay for a premium goes up by $1,000 from year T0 to year T1. Whereas for people for the same people, for the second option, PPO 500, their premiums go down by approximately $1,600 from year T0 to T1. So this shows that the relative price change for someone in this tier, in income tier 5, changes by $2,600 from year T0 to T1. So that's what I mean when I'm talking about a significant price change. And so in essence, because T1 has a default option, you would expect consumers to be making quite different choices in that period if they were kind of making the same style choice as they were making in year T0. So one more piece of evidence for switching costs here compares the behavior of cohorts of new entrants to the firm over 2 consecutive years, over years T0 and year T1. So in year T0, well, first let me point out that new entrants are kind of an interesting population here because any kind of time you enter the firm, you have no default option, and you're choosing a new plan, so you have no switching costs. So what you can see is that for employees who start in T0 but then have a default option in T1 after these large price changes occur, you can see that they actually stay in pretty much the same plans, which is not surprising given kind of the dominated plan choice results I showed, showing some persistence, some significant persistence in plan choice. However, if you then look at the behavior of the next cohort of new entrants, their choices reflect the price changes quite strongly. So there you can see that these kind of new employees are making kind of active choices in some sense, whereas the people who are left over are making very persistent choices. So a natural follow-up question here is, are these two groups really similar demographically? So what you can see is that they kind of have like the exact same ages, the exact same distribution of income, and in addition, something I don't show here is that they're also almost identical in terms of distributions of ex post claims, so after they enroll. So these two groups are really the same and just making quite different choices.
They're the same too, because you said you studied whether people are quantitative, and I think that's an interesting question. Are there people who would even want to go in and look at the numbers, or people who would be intimidated by going in and looking at the numbers?
Yeah, so
And did you see any difference between quantitative and non-quantitative?
Yeah, so there's a chart in the paper that looks at that shows that as one statistic.
Right.
And in fact, what you find is that people who are more quantitative actually are less likely to switch. But the reason, there's a very likely reason for that, which is that people who are more quantitative also have are usually making significantly more money. So for example, could have a higher time cost or be less concerned about kind of which health plan they're in some sense.
I was going to ask you for a conditional, like myself when I was just out of grad school versus myself now. So conditional on on like a tier 2 employee who's very quantitative. Do they have different choices, or was there not enough data?
So that's something I haven't looked at yet, but so in the population overall, I think about 15 to 20% of people are classified as quantitative. So then when you start slicing it by tiers, it becomes difficult.
Yeah, and given that they probably pay a lot more money, there's probably very few in like tier 2 who are quantitative.
Right, exactly. So in moving towards the model, I make kind of 2 sample restrictions based on that kind of narrow down the sample I'm estimating the econometric model on relative to the full sample of employees. So first, as we discussed, I restrict the choice to employees who only choose PPO options. So that has the benefit of that I observe detailed medical data now for each employee, and not listed here is the benefit of the kind of incumbent plan issue, which we talked about earlier. A cost for this is the potential for selection bias, but also, as I mentioned earlier, there's very, very little switching between the nest of people who choose PPO plans, the people who choose the nest of PPO plans into the nest of PPO options. So there's very little back and forth. So these two options are quite horizontally. HMO and PPO. So those two options are quite horizontally differentiated, which means that there's fairly low potential for selection bias for excluding these two options.
Did you look at the correlation with the tiers for HMO and PPO?
You mean with the income tiers? Yeah, I have that information. So it's actually, the income information is quite similar. So for people in the 2 HMOs and the 2 lowest PPOs, the income information is similar. For the people in the most comprehensive PPO, they're richer by probably $5,000 to $10,000 income. So So the median income for people in kind of those other 4 plans will be about $45,000, and the median income for people in the most comprehensive plan is probably about $55,000. The second restriction I make is that employees have to be continuously enrolled for a 3-year period from year T-1 to year T2, so from the year before the menu change to the year after the menu change. So this restriction is made predominantly for precision. So what happens is, because of this restriction, I can observe a full past year of medical data for all employees at the time of plan choice. So what that means is that I can create a distribution of health expenditures for each employee based on their past information, which is what we'd want, because obviously the ex post information is kind of a worse realization of their information set at the time that they're making decisions. So a cost of this restriction is that it selects a specific population. So it selects a population that's kind of a longer tenured population within the firm, and I'll show the demographics on that in a second. And it also means that in the model, I'm not kind of using the new entrant identification that I just showed you. So I'm currently working on another specification that does include that population, but where I have to use more coarse health information. So either age-in demographics or ex-post health information. So this chart shows the demographics for 3 different samples. So the first sample is for all employees who are ever at the firm. The second sample is employees who are enrolled in a PPO option at some point over the period I observe. And the third is the final sample, so PPO option plus the tenure restriction, the 3-year tenure restriction. So what you can see is that moving from all employees to just PPO employees has very little selection in terms of the demographics. Moving to the final sample, so adding the tenure restriction, makes employees older, it makes them richer, and it selects a population with a larger family size. So with more likely to be a family, so covering at least a spouse and a child. And also selects what I call managers within the firm. So kind of, as you'd expect, longer tenured employees. So the preliminary results kind of show pretty convincing evidence of large switching costs. The econometric model I estimate is what's called a panel discrete choice model, which I'll describe kind of, I'm going to show what that is in a second. And that's going to quantify switching costs, health risk, and risk preferences, as I discussed earlier. And the model is going to be explicit estimates of the expected utility function, which is only done in kind of 1 or 2 other papers I'm aware of empirically in industrial organization. So in the model, each family is going to have a distribution of uncertainty at the time of plan choice over their future medical expenditures for the year. And that's going to be a plan over their out-of-pocket medical expenditure, and that's going to be specific to each plan, because each plan has specific financial characteristics. And so
you're assuming a lot when you say that the consumers maximize over their expected utility. Do you really believe that?
Sure, I'm going to talk about that actually in a second. So in the model, in each period, consumers choose between the set of plans J, which is the set of 3 PPO options. The uncertainty they face is with respect to their medical expenditures. And then they have a utility index function, which is what their utility is for each state realized from this distribution. And I'm going to kind of talk about that more explicitly in a second. Now, as you brought up, one of the underlying assumptions here is that consumers have rational expectations about their health expenditures, and about plan characteristics, in fact. So that could be wrong in at least 2 ways. So one way it could be wrong is that consumers could actually have more information than I observe in the past medical data. For example, a case where you would expect that to be true would be the case of pregnancy. That's kind of like the canonical case that's brought up. You could also expect consumers to have less information than what I have in the model, because in estimating this distribution F, I combine the detailed medical data with a sophisticated medical software package developed at Johns Hopkins Medical School that basically maps profiles of diagnoses into future profiles of medical risk. So that's a sense where you would expect consumers to kind of know less information than I have.
Did you dentist and they say, you know what, the crown which I'm about to sort of say you should replace is not covered this year anymore. Why don't you wait until next year?
Mm-hmm.
And you
That's
might
more
be-
information
and
than
you,
he has.
No, he might have that because he might see that I ran out of benefits in my dental, and therefore he could speculate that I might have some cost I defer to the next year.
So there's actually a rule in all these insurance plans, and I think in insurance plans in general, which people don't usually know about, where you can basically apply if you have expenditures in the last 2 months of your plan, in November and December, and they're under the deductible, you can actually do those expenditures then and apply it to the deductible in the next year, which gets rid of this issue.
No, because I had the opposite issue, right? I ran out of the
I see. But in that case, why you would want to do it now?
Want to do it
No,
now?
Christian, he answered your question. I mean, he is addressing your question.
Yeah.
No, the opposite question.
You,
Oh, okay.
you
Yeah.
didn't know about this rule, but if you did,
Yeah.
you've just gotten your crown done last year, said that'll satisfy my
So-
deductible for next year.
Christian is thinking about that situation that often shows up for dental plans, but I believe does not show up in your story.
Right, maybe because-
It's an annual cap, which is actually pretty low.
Which is low. yeah.
Sorry.
Which is not
Yes.
happening.
Sorry, I see. So yeah, so that could be possible. Now, only about 3 to 4% of employees go over the cap ever. Now,
Not in dental.
No.
Probably in.
no. So in this case, that wouldn't happen at all because when you go over the cap, so there's no cap on actual spending. The cap is on what you pay. So you would actually, yeah. So it's just the opposite.
Just the opposite. You want to incur all your expenses in the year in which you've maxed out, because then they're paying 100%.
So this is just the opposite from my
Yeah, exactly the opposite.
So you
Now,
would accelerate.
now on the first point I brought up with the deductible point, there, I mean, even though this is in like the insurance regulations, a lot of people might not know that. So in that case, you could still potentially see some substitution, kind of if you're below the deductible, before to after. So this is kind of the simple choice setup. Moving forward, the utility index that was in the previous choice setup makes specific assumptions about how consumers make choices under uncertainty in the model, in the expected utility framework. So the assumption on risk preferences in the base model is that consumers have a constant absolute risk aversion utility index. So what that kind of mathematical specification implies is that your risk preferences are kind of invariant to what your base wealth level is. So it's invariant to kind of like a certain flow, a change in the certain flow. So that's convenient here because I don't observe, for example, what each family's kind of aggregate wealth is or total wealth is. So what this assumption means is that that's not important in the model.
Going back to the last one, did you do any, I mean, in the end, it is almost as if you saw that people were not making good assessments of what their risk was
Mhm.
because they were not moving to the plan that they should have moved to, in a way. So is there any way that you could, that one could gather data to see how rational the choices are, other than just looking at the end and saying, my God, in hindsight, they seem irrational because the consumers made
maybe the
a choice.
costing switch was really
So-
high. And you
Yeah.
don't know.
So I think what you're saying is that I'm assuming that consumers make these kind of very rational choices. It could be that they're making choices which aren't very rational at all. Now, so I guess there's a couple points. So with the new entrant kind of example I showed you with the data earlier,
Yeah,
that data was independent of how people are making. That's also it made kind of no assumptions on how people are making decisions. Now I agree though. I mean I agree that this is a specific form that if consumers are kind of making looser decisions based on heuristics, could for example lead to different estimates of switching costs than what I'm going to find. So so the issue there is that so long as consumers are kind of perfectly rational in active periods and but then make choices that aren't so good in kind of periods where they have a default option, the model is kind of quite close to accurate. In the case where in the case where consumers make poor decisions to start and then even worse decisions later, then I may be kind of somehow introducing some bias into the coefficients.
In other, put it differently, your switching cost actually measures my. Jennifer seems to think my switching cost is 0, and you say no. The fact that I choose a plan, a state in the plan which is $2,000 higher, means that my switching cost must be over $2,000.
Right. So.
I simplify.
That's the way you calculate the switching cost, right?
Right.
Not by measuring anything
Good.
real, but just by comparing your idea of what the consumer should have done with what they actually did.
Exactly. And so that's going to be kind of those two things. So that's absolutely right. And then kind of another issue is can I separate? So this has been a problem in kind of the industrial organization literature on switching costs. Can you separate between switching costs and kind of some unobserved consumer preference for a specific plan? So like if say like a lot of say certain consumers have kind of are extremely risk averse, and they're going to choose kind of a specific plan no matter what. And so then the question is, am I measuring that as switching costs? Now, the answer is no, and that's kind of one of the interesting features of the data. Because I observe all consumers making decisions in 1 year without switching costs and 1 year with, and it's the same consumers and I can follow them over time, I can basically identify under some distributional assumptions on what the distribution of risk preferences are. I can identify first what those unobserved preferences are in the first period where there's no switching costs whatsoever, and then I can identify switching costs by looking at the variation in choices between the first year and the second year. So here, a consumer's base monetary amount for any given state realization of the out-of-pocket expenditure is composed of a premium, which is their person-specific premium. It's composed of eta, which is a switching cost, which I allow to depend on whether you are a family or not. You could also think about that as depending on a variety of other things, which I'm kind of currently working on. And I also have a term delta, which is a taste parameter for plan which is PPO 1200, so the least comprehensive plan. So the reason why I have kind of a specific shift in preferences for that plan is that that plan is linked to what's called a health savings account, which differentiates it from these other two plans. And so even though the same doctors are covered, it could be different in terms of taste, because in the literature, kind of health savings accounts are known to cause significant hassle costs in terms of can you use the credit card from this health savings account with your provider, things like that. And in many cases, the answer is no. And so in that sense, that plan is quite differentiated by kind of a taste for how willing you are to put up with this hassle cost. So that's why that's in the model as well. So then, based on kind of distribution, the distribution F hat of medical expenditures, which come from a separate cost model, which I'm going to describe in a second, consumers then maximize their expected utility. So, sure.
Some of the parameters in this formula you know, and some of them you're inferring.
Exactly.
Which ones are you inferring besides the switching costs, the delta?
So the delta is being inferred, and that's inferred based on kind of how people are making choices as well. The A term is being inferred, where that's basically a term that reflects the fact that in the data, any consumers who kind of have more than $40,000 in total medical expenditures always choose the most comprehensive health plan, no matter what, even if they're kind of new entrants and the plan is dominated, etc. So that parameter is being inferred. Yeah, so those kind of three parameters are the primary ones being inferred. Now, another parameter being inferred, which is important, is this parameter, gamma k, which is the risk parameter. So that's also being inferred.
So what's the concept of the most comprehensive plan which is dominated by other? I mean, how can you have both? I mean, aren't they contradictory terms?
Which one?
Most comprehensive and dominated
Even if
by
it's
something
dominated,
else.
you said most comprehensive, even if it's dominated, and that almost sounds contradictory. So that's what.
So by most comprehensive, I just mean it has the lower deductible and lower cost sharing. It doesn't mean it's the best plan for you, obviously. Yeah, I mean, as you could see in the chart. So
There must be some cost what you really care about is the switching cost.
Mm-hmm.
There must be some cost in estimating the switching cost to have to estimate these other things too. How did you decide how many other things there ought to be? I don't quite know how to ask this question.
Sure. I mean,
It's an empirical question. No, it's a,
What determines the number of parameters you choose in this formula?
Yeah.
sure. So I mean, ultimately, what determines the number of parameters are the parameters that I think are behaviorally relevant to the situation. So by that, so it's clear, and that's informed based on kind of the raw data. So for example, the delta parameter that I have here, which is the taste for kind of the plan I was describing with the health savings account, that's there because it's quite clear that even in active choice periods, people shy away from that plan because of kind of this extra feature. Because that's the only other thing that differentiates it from these other plans.
These guys by eyeballing the data and saying these things look significant, so I better put in a parameter for this.
Well, I mean,
I'm just trying to find
no,
out.
I mean, I would prefer to think about it as kind of having clear like behavioral reasons behind that. But I agree. I mean, no, I think that that's accurate. Yeah, I think that that's
So
accurate.
is there some statistical bias then in that?
Um,
Because you look at the, before I mean, ideally you would look at some set of data, choose your parameters, and then look at a different set of data
Mhm.
to estimate them.
Sure. And I mean, in that sense, yes, because I didn't have a second data set like this. So I had to do it just with this one. And I mean, I definitely was looking through the data a lot first before I came up with this model. So to some, I mean, there could be a bias in that sense, but I mean, in a sense, it's also not that important because the really important things here are the large switching costs and the adverse selection, which is going to be based on the health risk distributions I estimate. And those things, it's extremely clear in the data alone that that the switching costs are quite large. And the adverse selection is just based on the distribution of health risk, which is kind of pretty simple. So in that sense, the kind of two core elements kind of are, I think, are pretty invariant to kind of, in some sense.
I could ask my question.
Yeah.
Which is, would be there a way to, I mean, I don't know enough statistics, that's why I'm asking it.
Mhm.
Would be there a way to say, okay, I look at a list of possible parameters, and now I do some consistency check. I actually leave out some of them, and if they give totally different values for the parameters I was looking at, but they had very small values, then something is sort of strange. I mean, is that
Sure.
a consistency way
So I guess the idea there, I guess the way that would usually be done is just by doing kind of what's called robustness checks, which would mean kind of looking at a variety of different specifications and seeing if the results are similar. And I actually do that. So, for instance, I make different assumptions on kind of what the distribution of risk parameters can be in the population. I've run specifications that are constant relative risk aversions, which is a different functional form for kind of the U function. And kind of a variety of other things. So I mean, I've run this kind of without, for example, the delta, etc. And the
so
kind
you're
of
showing us this, but in fact you tried many models.
oh, absolutely,
Yeah.
absolutely, yeah. I mean, it's kind of I think for the kind of believability, for the credibility of the study, it's important to have kind of alternative specifications that show that the switching cost amount that I estimate is actually quite similar across these variety of specifications, which is true. So kind of, I showed you.
Jennifer, we have 10 minutes.
Oh my.
Okay.
Okay, well,
Better
so
control
10 minutes.
something.
Okay.
I'm sorry, we ask a lot of questions, so
No, it's-
we'll try not to ask many questions for 10 minutes and try to give us some picture in 10 minutes.
Great, absolutely. So I'm going to go through the cost model very quickly, kind of on that account. But the important point here is that I'm using people's past medical data. I'm incorporating it into this sophisticated medical algorithm, which is giving me a mean level of expected future resource utilization for the next year. I'm then grouping individuals into cells based on this information. And then for each cell, I'm then estimating distributions of medical expenditures based on ex post realizations within the cell. And then I construct a very detailed mapping from total medical expenditures to out-of-pocket medical expenditures for each plan, which gives me the kind of final family-specific distributions of medical costs. So I already kind of talked about the model identification, so how I can separate switching costs from unobserved heterogeneity, which is a quite new thing in the literature on switching costs. The econometric estimation, which I'd be happy to answer a lot more questions about later, but I'm going to kind of gloss over right now, is basically a simulated maximum likelihood approach that simulates the individual specific parameters on risk aversion and the taste preference parameter, and then selects kind of the parameters that that maximizes the likelihood of those parameters based on the data. So, so in the results, essentially what I find is that there's very large switching costs. So the order of magnitude for an individual is approximately $1,500 in the model with normal heterogeneity, so a normal distribution assumption on gamma. And the results are similar with the log normal heterogeneity. So one thing I take away from these quite large numbers is that these switching costs can't possibly be kind of only transaction cost type story, obviously, because even at a time cost of like, say, $50 an hour, and it takes you 10 hours to kind of research and switch your health plan, that's still only $500. So this means that there's kind of a pretty significant either psychological or kind of inattention type component here. In addition, an interesting aspect is you can see that the difference between the family switching costs and the individual switching costs is about $900. So the difference between kind of prices and medical expenditures in those plans is kind of a ratio of about 3 or 4 to 1. So, so in some sense, if you would expect the transaction costs, of individuals and families to be somewhat similar, maybe differentiated by a couple $100.
No, I mean, now you have two partners you have to agree on it, so suddenly you have two people who trade hours, so it's double the cost.
No, it could. I mean,
Most people don't make decisions the way we do, Christian, which is why they're
Then it takes them a lot of time
We
to
have
convince
8
them
minutes
why.
left.
No, they just go, okay, you handle it.
so so on the risk aversion parameters, kind of these are the kind of Cara kind of numbers are not really interpretable. I kind of interpret those in a chart, and I show that the kind of risk aversion parameters that I estimate in the econometric model are actually kind of fairly comparable, quite comparable to kind of previous estimates in kind of the literature on risk aversion. So all I want to kind of take away from that now is that the risk results I'm getting are kind of consistent with kind of what other studies have shown. So in the counterfactual analysis, which is the simulations where I reduce switching costs, I think it's important to point out that kind of helping consumers make better choices and improving the consumer's kind of information set is kind of a cornerstone of current reform policies. So some potential policies that could actually be thought of that could reduce switching costs are personalized plan recommendations. So kind of giving an individual kind of simplified sheet of paper, kind of telling them exactly what plan would be best for them. Some other potential policies are decision-making tools, kind of that allow consumers to kind of help make better decisions on their own. And in the context of current national health reform, kind of umbrella kind of over these policies, they've discussed creating a strong oversight body that basically deals with all these issues in one body. So I'm going to skip straight to the full equilibrium analysis, but I'm going to talk about the welfare calculation before I get there. So on the welfare side, the change in welfare I observe is measured with a certainty equivalent metric. So what that means is that for each person in each plan, there's a distribution of outcomes they perceive at the time choice, so some risk they perceive. The certainty equivalent is a certain monetary value that's equivalent to this kind of risky gamble across all these plans. And the difference in certainty equivalence is just the difference between these certain monetary values as you switch across different health plans. And it's
so you assume this is personalized that this is
yes.
This depends
Yes.
on the individual
Yes.
and the cell they're in.
Exactly. So the consumer welfare is calculated at the individual level based on the model, and then the statistic I use is going to be kind of a mean of that kind of measure. And it's important to point out that the welfare change here is derived from a matching problem between consumer risk preferences and the actual health plan that stems from the adverse selection problem I was talking about earlier. So also in the full equilibrium analysis, I recreate the pricing rule that's used for these plans where, as I discussed earlier, plans are priced based on this lagged average cost rule for each plan. And employees are given a fixed subsidy that applies to all plans. So each employee only gets one subsidy, and you pay the full marginal price for more comprehensive insurance above that. So you pay the full kind of marginal contribution. So what I find is that when in full equilibrium, when you have the policy that significantly reduces switching costs, so this is the starkest comparison. It shows when you reduce switching costs from what I've estimated to 0, which is kind of a frictionless market. There, you can see that I kind of simulate the market for six periods going forward from year T0, and you can see that the market share for the most comprehensive plan decreases from about 1,000 to 200 when the market becomes more frictionless relative to kind of the benchmark case in the model, with the reason being that the prices for the more comprehensive insurance increases quite significantly. And you can see the reverse corresponding increase in the market share for the second plan. So people are substituting from the most comprehensive plan to the second plan. This chart shows kind of the actual impact on prices for individuals in the population, so for singles employees, because the average cost is done by kind of conditional on your family status. So this is kind of more conservative in some respects, because this is going to show kind of like a lower price change in the family calculation. And you can see that the price of the more comprehensive plan under the simulation goes up by about $2,000 in the long term relative to the case where there are switching costs. So the removal of switching costs kind of leads to these price changes you see here. So it leads to a relative $2,000 price increase for the more comprehensive insurance plan. So here I want to kind of draw your attention to this part of the table. So in year T6, this kind of just shows you kind of the results of the welfare calculation that I just described. And what you can see is that whereas in the partial equilibrium case, consumer welfare could only improve and improve by 10%, here the mean welfare change in the population is negative 6%. So on the whole, the population loses the certainty equivalent of $132, and then the percentage number comes from dividing that by total premiums, which is essentially an arbitrary metric in this case. I also show the distributional impact of this policy. So people who switch health plans as a result of this policy that reduces switching costs, their welfare actually increases by 13%. So people who actually respond kind of end up being better off, even in the presence of adverse selection. Whereas people who do not switch, who are sick people in the most comprehensive plan, or people in the middle plan who stay there and receive kind of sicker people coming down to their plan, those people are 27% worse off in terms of welfare. So those people are people who are really, kind of bearing the brunt of this policy change. So I think some of the implications for this are that in kind of current discussions, policy discussions, people are basically discussing one set of policies that are designed to improve consumer choices, another set of policies that are designed to deal with the issue of adverse selection, but they're not considering kind of the link between these two things and how that could be important. So for example, in the current kind of debate on health insurance exchanges, which is kind of a competitive market regulated by the government for insurers to participate in under certain characteristics, in that institution, the regulator kind of decides a couple specific contractual forms that insurers can offer in order to kind of mitigate cherry picking on the margin between different insurers. And so that's a policy that's designed to deal with adverse selection. And one thing my results show is that if you're kind of considering the design of that kind of institution, but you're basing it on the past literature, which kind of hasn't incorporated this effect of switching costs, then your design is going to be substantially different, meaning that if you're actually successful in improving consumer decisions, your policy is going to be wrong because it's going to have ignored this link between adverse selection and switching costs. So overall, I think that the paper shows large evidence of switching costs. What the sources of switching costs are, I think, kind of as we've discussed, is still kind of an open question that's important, especially in regards to which policies can reduce switching costs. I showed that the link between switching costs and adverse selection can have a significant welfare impact. An interesting kind of issue there going forward is I was kind of studying a self-insured firm environment in the kind of health insurance exchange environment I discussed. you might think that firms are more sophisticated and, for example, taking into account things like switching costs dynamically, so kind of pricing to to employees dynamically, which is something you already see in markets like, for example, consumer credit markets, and I would expect to see in a competitive insurance exchange. And overall, I think this is kind of one of the first empirical papers that kind of combines an analysis of a choice friction issue or a behavioral issue with a kind of traditional second best environment cited in IO, so with the problem of adverse selection specifically in this case. Any questions? Thank you.
I actually have a question. So the one thing that's obviously not in the model is moral hazard, right? That people consume more
Absolutely.
when they have more insurance. How would moral hazard relate to the things you're doing? So you didn't include it in the utility function.
So it's not in the utility function, but based on the it's back here somewhere. So based on the data, basically what happens is I observe people who are enrolled in the 1 PPO option before the menu change. Then when the 3 options become available after the menu change, I observe employees sorting into those 3 plans. Now, and those are kind of exogenously available for the first time in that period. So that implies that effect, kind of effect of utilization change over time, could be due to, as you select a new plan, could be due either to private information or due to kind of actual reduced utilization. And those 2 effects point in exactly the same direction. So in the sense that if you have private information or you have reduced utilization, you're going to kind of choose in the same direction. So what that means is that, so what I do is I kind of do what's called like a difference in difference approach, where I compare 2 groups to each other. Both groups are enrolled in the same PPO option in T-1. In T0, one of the groups chooses less comprehensive coverage. One of the groups chooses more comprehensive coverage. So then comparing the differences in the differences of the claims for those 2 groups kind of comes with a measure of kind of what the potential combined effect of private information and moral hazard could be. And what I find is that the combined effect is actually quite small in the data, implying that even though I could identify it in the model, it would make the model significantly more complicated, but not necessarily add anything, because I already see in the data that it's not like a significant effect in terms of overall expenditures.
Okay, thank you.
Thank you. Thank you.